In today's video, I want to talk about the most basic steps that you need to know as a new residential loan officer. I've learned these things when I first got started, and it saved me so many deals. If you don't know who I am, my name is Zevi Schaffer, and I'm the owner of a company called Loanbrook. We're both a residential and a commercial lending shop in Los Angeles. And I'm also in the process of creating something called the Part-Time Residential Lender Academy. So for a very short period of time, there's a promo available for you via link in the description of this video. This course is going to be amazing. It's going to be a roadmap that's going to help you walk through the whole residential transaction and earn a commission. So if you want to check it out, link is in the description. With that, let's dive in. I want to talk to you about the most basic mistakes and the things that you need to know about when having a conversation with a borrower. In the beginning, people are going to approach you for a loan and you might get flustered, and that's perfectly normal. Now, the thing is, there's a certain pattern of questions that you need to follow. And I wish somebody told me that when I first got started, because as you get nervous and you don't really know what you're supposed to be asking and why, is where the problem comes in. There's gaps in information that you need, and then you constantly have to go back to the borrower and it looks embarrassing. And that's exactly what we're trying to solve in this particular video. So as somebody who's just getting started, when you have an opportunity to speak with somebody, you need to understand that there are 4 parts of information that you need to be focused on. And I'm going to let you know exactly how we can basically create a map for ourselves to know where this information is actually coming from. It's actually the pattern of the loan application. Now, given that you've never taken one before, you wouldn't know about that. But I want to break it down into 4 different boxes for you so you could just reference back to this video as you're having these conversations, and it would actually help you. And call this first box information. When you have a conversation with somebody, it is very important that you capture everything within this bucket before you move on to the next step. And I'll explain to you why. Because at the end of the day, the only thing that really matters is the debt against the income. And the way that you're able to determine that is by having all 4 pieces of the puzzle. So when I say information, I'm referring to not only asking the individual in front of you what their name is, when they were born, all the stuff that you're going to need for the formal application, which you should be taking immediately as soon as somebody says that they're looking to either get a loan or get pre-qualified. But if I was having a conversation without actually filling out a loan application, the one big thing that I would want to know in this particular bucket, do they have children? If so, how many children do they have? And are they married or divorced? Does this person either owe money to a spouse, or are they receiving money from a spouse? So somebody is either single, married, or divorced. And now if they're divorced and they have children, are they responsible to pay anybody anything for alimony or child support? That is a liability I got to know about right up front. So that's basically where information comes into play. In addition to it, are they my borrower? Or is there another borrower? So you might say, well, it's obvious they're the borrower, they're buying, right? Well, what if they can't qualify? Is there a parent? Is there a spouse? Is there somebody who's not married to the borrower that I need to know about? And the reason I say that is because this is going to translate to how you run the credit, and this is also going to translate to how you take the loan application. Because picture this, if somebody is married, then you're taking a joint loan application. If somebody is engaged, but they're not yet married to one another, I got to take 2 separate loan applications. I got to run 2 separate sets of credits, right? And then I merge the liabilities together. I'm not trying to get ahead of ourselves. I'm just giving you the most basic information. And the reason I'm telling you this is because I've worked as a manager with teams of loan officers, and when I ask them these very basic questions, they had no idea. All they did know is that the person wants to buy a property for whatever it is, 700-800, they're going to put down 20%, and they're looking for the best rate possible. Not enough information. We need to go back to the drawing board. This format is going to follow the road map of the residential loan application. So like I said, first on our list is the information. We need to know if this person is single, married, or divorced, if there's any other liabilities that I need to know about. I need to know, so that would be their status, right? Their marital status. I need to know who my borrowers are. Is there a borrower or are there borrowers? Because now, not only am I going to account for their income, but I'm also going to account for their liabilities, which is very important. Somebody might say, yeah, I don't make enough money. I'm going to have somebody else who's going to co-sign for me. Well, I'm going to use their income. Sure, it's going to help you qualify, but do they have a ton of expenses? I don't know. I haven't run their credit yet. Very, very important questions to be asking up front. All this falls under the bucket of information. That's first on your list. And again, if you don't know where to get started, you pull up a copy of the loan application. We're following the steps. These are the questions that you're going to be asking. Next, I want to talk about their employment. There's two paths here. This is where there's going to be a fork in the road. Either they work in a company, and it's going to be very easy for me because I'm going to get a pay stub, or they're self-employed. If they work in a company, I can actually use the face value of the income to qualify, which is great. Your question to them is, how much money do you make? Number two is, what kind of employment is this? And the reason I say that, because if it's a straight hourly salary, that type of a thing, base income, it's great. But if we're shifting gears into bonus and commission income, it would be treated very much like a self-employed individual, meaning that they haven't been on the job for 2 years. I can't even use their income. So if somebody goes, hey, I got a booming business, things are going great, I'm looking to buy a place, can you help me out? Great, what do? I own a flower shop, I started it last year. So you're self-employed? Yeah, but I can't use your income because we don't have a 2-year history of you being self-employed doing this to have a track record. Now there's some caveats to that. Somebody might say, yeah, I started my business 2 years ago as a DBA doing business as, and I transferred over to a corporation. That's okay, no issues there. But the problem is if I don't have a 2-year history here, for somebody who's self-employed, I cannot use the income. Over here, if it's bonus and commissions, if I don't have 2 years, I can't use it. Unless they're just a wage earner. And if there's more than one borrower, then I need to get the information on both of them to be able to size it up correctly. By the way, if you have any questions about any of this, just drop it in the comments of this video. We'll go through it. I think it's important to not miss any of these steps when you're having a conversation. Focus on the information, get as precise as you can, move next into the employment, and let's figure out the income piece. Now, once we know the income piece, the next thing on our list, psychologically, right, is the liabilities. Now, when you're talking to somebody and you're just having a verbal, then the liability piece is basically a prequel, a pre-qualification. But when you actually run their credit, it turns more into a full pre-approval. The difference is there may be a lot of variation from what they're actually telling you to what the actual expense is. So I don't even focus much on expense if I'm actually taking a loan application. And I'll explain to you why. Because the second I run the credit, I can literally press a button and pull in all the liabilities and then go through them with the borrower. And so you don't need to spend a ton of time on figuring out liabilities unless you're just having a verbal conversation with somebody and they're like, yeah, I got like 3 or 4 things that are my credit, here's what they are. I typically don't do that if I'm actually trying to pre-approve somebody. The next step is discussing their assets. assets would actually be the amount of money that we need to put down to buy the property. So if I'm taking an application and I'm asking somebody, hey, how much do you want to buy a place for? And they're like, I don't know, maybe 700,000. And I'm like, okay, how much of a down payment? And they're like 20%. So, right, 700 purchase, 20% down would mean that the down payment is 140,000. But when I ask them, how much do you guys have in the bank? And they say, well, we got $40,000. We stop because now we realize that there's a problem. The borrower needs 140, they have 40. Where's the extra 100 coming from? What about closing costs? What about reserves if we need them? We don't have that money. So that's the conversation that I'm having before I go through, yeah, let me tell you what the rates are and what we could do for you, this and that. Do you have enough money to put this deal together? If they don't, then is there somebody who's going to be giving them that money? Meaning, is there going to be gift funds from a family member? And if there are, then I would like to know that information up front so I can mark that. Reason being is, if you do end up pushing this file forward, you do have to note it, because the second it goes into underwriting, underwriter is going to ask the exact same question I'm asking right now. Somewhere between income and liabilities lies the actual credit. All right? And the reason I say that is because you can only position different programs according to the actual credit score. So remember, we said we're going to find out their income, we're going to pull in their liability by running their credit. And so we know that typically a minimum credit score for conventional lending is 620. If they don't have that, then there's a problem, all right? And that's another question that you can ask between these two steps. As we know now what the assets piece is, now we can further position the deal by understanding if they have enough money to close, or are we gonna actually need a cosigner or gift funds to be able to put this deal together, all right? Now, ultimately, outside of credit, we need to know if this individual has any other REOs, right? Which is real estate schedule, okay? And so if they have any other houses that we need to know about, then we gotta make sure that we include these liabilities when we size up the deal. Meaning, we need a mortgage statement, and we need insurance, we need a tax bill, HOA if they have it, and they may be keeping a property that they currently own, exiting that property, and then buying something else, right? And if they keep that, then I gotta know what the expenses are, and I can actually give them credit of up to 75% of whatever the rent would be against the proposed expense, right? So they may have other real estate. So we got to definitely factor that in. The purpose of this video is to understand the different steps and the questions that you have to ask the borrower. Don't just touch the surface and say, okay, you're looking for an owner occupied with 20% down, and this is going to be your rate, and let's get started type of a situation. Dig in deep. And when you dig in deep and you go through what I just discussed with you, which was, information, employment, /income, and then they're going to sign authorizations, which will allow you to run their credit, which is going to show you their liabilities. And then after that, we're going to take a look at their assets. Again, all questions that we're going to ask them, and then eventually we're going to see if there's any other properties that we need to know about. This here will give us the full picture, and by taking the loan application, which is basically what this map is. This is the map of the loan application and running their credit. The most important thing you could possibly do is two things. Take the loan application. When somebody is interested in moving forward, immediately take the loan application. You saw how much information we go through. You might say, Zevi, great news for us. We have an electronic system built into our company, and we can literally just send the link to somebody and they can complete it, and I'll get it back when it's ready. Big mistake. And the reason it's a big mistake is because it doesn't allow you to build the rapport, the relationship. It doesn't answer any of the questions that we just asked right now to be able to get literally full transparency on the transaction. If this person is thinking about traveling, you need to know. They're not going to be available. If this person is thinking about buying a car and adding to their liability, you need to know. If this person has a property now, they're trying to do a refinance and they're in the middle of a renovation, you wouldn't know any of these things if they're filling up a link. You're not going to be able to do the transaction. So that's why these are all super important things. I know we covered a lot. I wanted to touch on this because by running their application immediately and running their credit on the spot, you're getting so much closer to the borrower. You got all their information. You got their credit card information. You ran their credit. You've discussed the items on their credit with them. They're not going to go anywhere. Don't think that by touching the surface with somebody you did your job. You didn't do anything. It doesn't matter if you don't have the lowest rates in town. If you go deep with a borrower and they know that you care and that you're knowledgeable and you're asking them all these questions that the other guy's not even going to get near, you're going to definitely earn the business. All right. So if you have any questions, drop them in the comments for me. Remember, I am in the process of building the part-time residential lender academy. If you're interested in learning more about becoming a residential loan officer, this is going to be a wonderful roadmap for you to follow to be able to teach you how to do that from start to finish. Otherwise, if you enjoy this video, please give it a thumbs up. It really helps push this video to other people like yourself who might be looking for this information on both YouTube and the internet. If you enjoyed the video, please subscribe. Otherwise, thank you so much for being here, and I'll catch you again on my next video. Take care.